I want to state that this video is not promoting Ponzi schemes of any kind. I will not be talking about crazy returns in short periods like 60% ROI per month, or the type of crazy returns that Nigerians are typically interested in. I will be talking about index funds, and index funds are a safe and reliable way to invest in the stock market, and you get good returns from compounding your interest over a very long period. So if you're looking for safe, stable and gradual growth on your investments, this is the place to be. And if that's not your type, you want investments with a touch of Ponzi, then please kindly check out. But hold on, don't go yet. I was joking. Just make sure you hit the like button, subscribe to my channel, and share this video with your friends so that they can come over here, watch me and learn. My name is Anne. Welcome to Money and Business Blog, where I talk about personal finance and where I make videos about fintech. And I am so glad that you can join me today. And I'm super excited for this video because it's about making money, which is one of my favorite topics. So sit tight and let's get started. At the end of this video, you know all about index funds investing and how you can use it to retire with 100 million Naira. And you'll be able to get started immediately. So you want to watch this video to the end. Now imagine you're trying to invest in the stock market for the first time, and you know that means that you're buying shares of a company and hoping that the value of those shares go up in time so that you can make a profit. But you have just 10,000 Naira and there are so many companies to invest in. So should you buy GT Bank or Dangote shares? What about Apple? What about Netflix? What about Amazon? What about Facebook, Tesla, Walt Disney, Coca-Cola? How can you decide the best value for your tiny 10,000 Naira? Well, is it not better to just use the money to buy pepper soup and call it a day? Well, here comes index funds investing to the rescue. Index funds mimic financial market indexes, and a very popular financial market index is the S&P 500. This index tracks the performance of the 500 largest publicly traded companies in the US. I'm talking about Apple, Google, Amazon, Microsoft. These are some of the companies that it tracks. Now, an index fund that mimics the S&P 500 matches their portfolio with the companies in this index in the same proportion. So if you invest in that fund, you automatically have invested into these 500 companies. Now, index funds mimic so many other things, not just the S&P 500. You can get index funds that mimic the total stock market index, which tracks the entire United States equity market. This means you have access to all the companies on the US stock exchange. You can also get index funds that mimic industry indexes. For instance, funds that mimic best performing companies in a sector, like best performing tech companies, best performing healthcare companies, best performing consumer services companies. There are so many options for you. But why do all of this, and how is this going to help you get your 100 million Naira retirement money? I'm going to get to that in a bit, but I'm feeling a bit tired. I need some motivation from you guys. All I need for you to do is to like this video right now and subscribe to my channel if you haven't. And as always, share this video with your friends so that they can learn from it, just like you're doing so now. Okay, so I'm going to sleep for a bit while you do that. Okay, I'm kidding, but I'm feeling pretty motivated right now, so let's proceed. Here's why index funds are so great. The first reason is that you're significantly lower risk compared to investing in individual companies. Whatever losses a company in the index funds portfolio makes will be balanced out by profits from the other companies. So if you save consistently with an index fund over a long period, it is extremely unlikely that you lose any money or that you lose a significant portion of your money. In fact, if this happens, then it means that the world has really big problems. Okay, maybe there's been an apocalypse, maybe there's a zombie attack, because why else would the value of the largest 500 companies in the United States drop so significantly over a long period? Or why else would the value of all the companies in the United States stock market drop so significantly over a long-term period? Another reason it's great is that they're cheaper to buy than buying individual stocks. If you wanted to buy the stocks of of the entire 500 companies, you know that's really expensive. Also, it's a great way to diversify because you're indirectly investing in very large number of companies spread across different sectors, so your risk is spread. The fourth reason is that it's a good way to earn consistent returns. The truth is that many mutual funds managers are trying to beat the stock market. So for example, if the value of the entire United States stock market grows by 20% in a year, they're trying to get more returns than that. And guess what? Majority of them are failing, but they're charging you higher fees for it. So why not just invest in the entire stock market yourself and keep your 10,000 naira safe? Sure, you would probably miss out on the dramatic 1,000% or 100% gains you would have gotten if you had invested solely in Tesla or Zoom 3 to 4 years ago, but you would not lose your 10,000 naira. And in a 10-year or 20-year period, you could have gained a lot more money than your counterparts who are jumping from one hot stock to another without proper knowledge. When doing this, the brokerage you use is extremely important because of something called expense ratio. You're going to pay the brokerage a percentage of your earnings for managing the index fund on your behalf. So you need to pick a brokerage that offers very, very low expense ratios in order to maximize your returns. Now, these are the most popular and cheapest brokerages: Vanguard, Fidelity, and Schwab. They're recommended by most investors, and their expense ratios are typically less than 0.5%. They also offer several types of index funds, the most popular being indexes based on the S&P 500 and the total stock market. Now I'm going to show you some of the index funds that each brokerage offers on your websites so that you can see for yourself. I'm also going to leave the links to the website in the description box below, so make sure to check it out at the end of this video. Now let's see, how much do you really stand to gain from index funds? I've created a very simple model using returns from the S&P 500 and total market index funds of Vanguard, Fidelity, and Schwab over the last 5 years and over the last 10 years. So now imagine that you've been saving 100,000 naira a year for those periods. This is roughly 8,000 naira per month. The returns from each brokerage are quite similar. On average, if you've saved for the last 5 years, your money would have grown by 61%. And if you saved for the last 10 years, your money would have grown by 128%. If you saved 8k per month over the last 10 years, you'd have over 2 million naira right now. Your money would have doubled. This is so great, isn't it? Remember that this will not be your only form of savings or investments. This will only make up a portion of your investment portfolio, guaranteeing you steady, stable returns. You could still make money from high interest savings accounts, which I've covered in this video where I analyze the top savings apps in Nigeria. Or you could choose to make more money from cryptocurrency. I've also made a video to understand Bitcoin for beginners. You can watch it right here. Or from general investing in the stock market, in real estate, in commodities, whatever you choose. You need to decide what percentage of your savings you want to put in index funds. Generally, if you're older in age, you want to take less risk because you're closer to retirement, right? So you should be putting in a larger percentage of your money in index funds. If you have a low risk appetite, this is a good option for you. When you're investing in index funds, you're thinking long term. You're thinking 20, 30, 40-year periods. This isn't for spending returns every 3 months. This is a place you put money in and you forget about. It's great for retirement savings, saving for your future children's education, saving to buy a house if you don't have access to mortgage like many of us in Nigeria. It's not where you put savings for a car, school fees, travel, and so on. And remember, the earlier you start, the better. As you can see from the model, the longer time you invest the money, the more returns that you stand to make. Now, how much would you need to have saved per month over the last 10 years if you wanted to have 100 million naira in your portfolio right now in 2021? Now I'm going to show you, but as usual, baby, I need some motivation. You know you love this video at this point, so click the like button if you haven't, subscribe to my channel if you haven't, and send this link to your numerous group chats so that your peers can gather here and gain this knowledge, okay? Thank you. So I used Vanguard's S&P 500 index fund to calculate this. you need to have saved 375,000 naira per month for the last 10 years or 125,000 naira per month for the last 20 years to have 100 million naira in your portfolio right now. But what if it was the last 30 or 40 years? Then the monthly contribution you need to get the 100 million would be reduced significantly. And I know you might say, oh, the savings period is too long. Oh, I can't do this. But remember that you have time now. Retirement is coming whether you like it or not. You're going to stop work one day and you'll need money. Or you're going to need money for some giant expense. You know, if you're in your 20s, in 30 years, you'll be in your 50s. That is still far away from average retirement age. You want to have stacked up a lot of money by then. If you're in your 40s or your 50s, you're watching this video and you don't have any retirement funds whatsoever, start immediately. A good way to start will be subscribing to my channel and liking this video, but I'm sure you already know that by now. So let's move on to more important things, like how do you start right now? Where can you access these index funds? Unfortunately, you can't buy Fidelity and Schwab index funds if you reside outside of the US. However, you can get Vanguard if you reside in these countries in Europe and Asia. So what does this mean for my beautiful Nigerians and Africans? Does this mean I've been wasting my time in this video? Oh my god. Absolutely not. Here comes ETFs to the rescue. ETFs are exchange traded funds, and most index funds have an ETF version. The difference between index funds and their ETF version is majorly in how they operate and not the returns you stand to make. So with an index fund, you have to buy directly from the brokerage providing it, and the minimum initial investment can be quite high. For example, the minimum initial investment on some Vanguard index funds is $1,000. This is 500,000 naira, which is quite expensive for the average Nigerian. However, ETFs can be bought, sold, and traded like normal stocks outside of the brokerage providing it. So depending on the country you live in, you can buy ETFs from online brokers like Robinhood if you live in the United States, or Trove, Bamboo, and Chaka if you're in Nigeria. Also, the minimum initial investments in these online brokers are usually quite low. Now, I made a video comparing these three companies for buying foreign stocks from Nigeria, so you might want to check them out and make your choice. The significance of this is that ETFs are more liquid, which can be a good or a bad thing. It means that with index funds, it's easier for you to be disciplined because the money is with the brokerage. However, with ETFs, you're keeping your retirement money in an account that also has money that you're using to trade individual company stocks, and that you can also easily withdraw. So the temptation to spend the money is a lot higher with ETFs. You should also note that the fees you pay on your returns will be higher, because after paying Vanguard or Fidelity or Schwab, you also need to pay commission to the online broker that you're using. So I talk about this in the comparison video as well, so make sure to check it out after watching this one, okay? Another difference is that when an index fund pays dividends, you can request that it be reinvested immediately so that you don't touch the profits at all. You can't do that with an ETF. You have to reinvest it manually and incur new fees from your online broker while doing that. So again, the temptation to spend the dividend is very high, the temptation to liquidate your investment is very high, and you spend more in fees. So if you're going to do this from Nigeria or Africa, you have to be highly disciplined. The beauty of investing lies in compounding. You don't want to spend all of your returns. No. The first step is to decide on the index fund that you want to buy. You can decide on S&P 500 or total market funds, international stock funds, sector-based funds, and so on. It's up to you. Do your own research or consult a certified financial advisor to decide on an index fund investment strategy. The next step is to find out the fund's ETF version. For example, Vanguard's S&P 500 based index fund is called VFIAX and its ETF version is VOO. So you search for this ETF version in the online broker of your choice and you make your purchase. Stephanie, quite easy, right? So what are some action steps that you can take today? If you live in countries where it's possible, create an account with Vanguard, Fidelity, or Schwab, or any other brokerage offering index funds. Make your choice through your own research. And if you live outside of these areas, no need to worry, you're going to purchase the ETF version of these index funds. Just make your choice of the online brokers in your country that allow you to buy foreign stock. Again, for Nigeria, I've made a video comparing 3 of the most popular ones, so make sure to check it out, okay? And then you need to come up with your index fund strategy. Which ones do you want to invest in? How much do you want to put in? And over what period? Do you want to spend the returns immediately you get them or reinvest them? No amount is too small if you're getting steady, stable returns. And you don't have to put in 100% of your savings. Decide what works for you. You also don't have to listen to anything I've said. If you're doubtful, you can check out these more successful YouTubers.
Hi guys, it's Mark. So did you know if you save $200 per month at an 8% annual return, then in 45 years you would have over, wait for it,
$1 million.
Hey guys, it's Aman
and Christina
from Our Rich Journey. Today we are talking about the index fund. And if you know our story, you know that we are index fund millionaires.
Or you can hear from the chief of investing himself, Warren Buffett.
The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm.
You don't have to do extraordinary things to get extraordinary results. You can try to pick stocks on your own, you can choose to do crypto, you can choose to do some crazy Ponzi scheme. The truth is that many people will fail in this manner because they don't have the right education and the right temperament. So why not just do something that is easy and has been proven to work from inception? And on that note, I will leave you. Thank you so much for watching this video to the end. It's so surreal to me that I have over 600 subscribers. I mean, I started this channel to have fun and share knowledge, and I had no idea that people would take me seriously. I mean, in the grand scheme of things, 600 subscribers is really small, but it means the world to me. Thank you for giving this shy, introverted girl a chance. See you again in my next video, or hang out with me on Instagram at Money and Business Blog. Have a lovely, lovely week. Mwah. Bye.